The AI bubble just burst. Over the last 48 hours, Palantir dropped 11%, Nvidia slid 6%, and the big short of the decade is now betting against both of them. Is this the end of the AI run or the greatest buy signal of 2025? Stay with me for the next few minutes because I'm going to show you the one metric that separates the true cash cows from the bubble trash. Welcome back. We are seeing maximum fear in the tech market right now. Even as the broader market shows some stability, the heart of the AI trade stocks like Tesla, Palantir, and Nvidia are bleeding out. This isn't a small correction. Palantir fell over 11% and Tesla was down 10.5% in just 2 days. The Nasdaq Composite recorded its first monthly loss since March. The reason? Valuation worries, and a famous short seller, Michael Burry, is targeting Palantir and Nvidia, making a huge bet that they will crash. This combination of huge stock drops and high-profile drama has created a massive, immediate search volume for end-time AI stock crash. Now, this is not the time to panic. It is the time to look past the noise and find the hidden strength. Most people looking at this crash are asking a simple question: buy the dip or sell everything? But that's the wrong question. You need to ask, which of these companies actually make real cash? This is the core of our winning angle, the FCF filter, free cash flow. FCF is the cash a company generates after paying for all its operations and capital expenses. It's the metric that separates hype from health. Many AI companies are still valued purely on future promise, but the strongest ones are generating massive FCF right now. For example, while Palantir fell hard, we need to check their FCF margin. Is their software so mission-critical that they are still pulling in huge cash flow? A strong FCF margin, say 30% or higher, tells you the crash is likely just a valuation reset. A weak or negative FCF margin means you should treat this as a signal to run. Don't buy a stock just because the price is low. Buy a stock because the underlying business is a cash machine. The search volume has exploded because of the dramatic tension between Palantir's CEO, Alex Karp, and the big short investor, Michael Burry. Burry, so famous for calling the 2008 housing crisis, is now betting that these AI companies are headed for a crash. Karp has publicly criticized Burry and other short sellers for questioning the AI revolution. This high-stakes fight is a perfect opportunity for us to learn how sophisticated investors actually look at this problem. When a famous short seller targets a stock, it tells us one thing: the stock is overvalued based on traditional metrics like price to earnings or price to sales. For a content creator, this high-drama topic isn't just news. It's a valuable educational moment. We can look at how to track short interest from the percentage of shares being bet against. A high short interest, especially during a price drop, can set the stage for a short squeeze if the stock starts to turn around, sending prices flying even faster. Use the drama to understand the mechanism of the market, not just the emotion of the moment. If this were a true market crash, every stock would be falling. But look closely at the data from the last 48 hours. The major indices, the broad market averages, have actually managed to finish the week on a high note. Yet, the tech-heavy Nasdaq still recorded a monthly loss. This is the divergence signal. It means the money is not leaving the entire stock market. It is leaving highly specific sectors that are considered stretched or risky. Money is rotating out of the speculative AI names and into safer, more proven areas. This rotation tells us the market is getting smarter, not panicking entirely. If you own a large, quality technology company like Microsoft, which saw a smaller decline of 2.5%, you might feel less pain than someone holding a high beta name like Palantir, which fell over 4 times as much. This confirms that investors are finally demanding financial quality over pure growth hype. What is the immediate impact? Expect more volatility. The heavy selling in names like AMD and Nvidia means the market is trying to find a new, lower floor for these stocks. We are likely heading into a period where earnings results in FCF will matter more than exciting headlines about AI advancements. The future prediction is simple. The speculative bubble phase of the AI trade is over, but the actual AI revolution is not. The companies that survive and thrive will be the ones that can prove, with cash and profits, that their technology is truly essential. Your strategy now should be patient and precise. Always check the free cash flow. Don't chase the fear, chase the fundamentals. If you want to stay ahead of these massive shifts and learn exactly which stocks pass the FCF filter, make sure you subscribe. I'll see you in the next one.